Welcome to another week of the Educated Homebuyer Live. It is Wednesday. It is time for Josh and myself to answer your mortgage and real estate related questions to help you become educated homebuyers. So Josh, a lot of changes since last week. Rates have improved? No, I don't remember. Either way, we've got CPI coming out tonight or tomorrow rather. We're looking at some charts tonight. We're going to talk about inventory. We're going to update you on the economy. We're going to talk about Fed Chair Powell and all his wisdom. Josh, welcome to the show.
Jeb, I am thrilled to be
Thrilled
here.
to be here.
To recap all of the data that we've told these folks is so important that has not moved the market one bit over the last 10 days or so.
But the good news is rates aren't any higher than they were last week. Kind of in that, we're going to look at the charts, but nevertheless, the market's kind of holding steady. It's that time of the year, that lull, the seasonality is in full effect. Summer's here, vacations are happening. For a lot of people, I'm still at home, no vacations, envious of all those who are vacationing. But before we get, too sad here, Josh, let's take a look at some charts and get us moving in the right direction. So as we always like to do, we like to start with inventory because inventory leads the direction in which the economy is headed. I'm going to pull up some notes here just so I have the stuff accurately discussed, if you will. So where do we stand? So 653,000 single-family homes unsold on the market at the moment. That's up 1% for the week, 40% more than last year, Josh. So we're going to take a look at what that actually means in some areas of the country. But before we do that, we're going to take a look at Orange County and Huntington Beach. So Orange County is sitting at 3,074 listings, Huntington Beach at 182. Orange County is up just over 2% week over week. Huntington Beach up 3.3%. We're close. We're close to hitting the peak. There's people believe it's going to be September, October. We'll see. We'll see what it actually shakes out. But either way, continue to update you on what's happening there. So active inventory. So this is the first look at numbers from June, which again, we know is a month old, but based on how the data comes in, it's important to understand that year over year number and then compare it to a more normal market in 2019. So you can kind of see out of the cities that we're talking about there, Denver, Las Vegas, Nashville, the Northwest, which is actually considered a region for those of you who don't follow geography. That's not a state or city. Portland and San Diego. So out of all of those, year over year numbers are up pretty good, considerably, with Denver being the highest, almost 70% year over year. But then when compared to 2019, all of them are still below those 2019 levels, except for Denver, which is actually up 7.3%.
That
New
stuff
listings
always amazes me there, Jeb,
Yep.
that a lot of those cities are real close to each other. Like Vegas and Denver are not far away. Portland and that Northwest metro. It's interesting. Most of those, other than Nashville, are here on the West Coast. Similar audiences, people can move between one or the other to some degree. It's interesting to see the variation.
Agreed. I definitely agree with that. New listings. So new listings, 71,000 new listings unsold again this week. If you add in the 16,000 immediate sales, that's 87,000 sellers, which is 12% more than last year. Essentially the same trend we've had all year long, with just slightly more sellers. In 2022, there were 114,000 total new listings, just for context. So a lot of new sellers in 2022. Obviously, that's the time when rates started to rise. People started to panic a little bit. We're out of that panic stage at this point, but we're just in the middle of this just weird time in the market where not a lot's happening. And you guys are seeing it in a lot of the numbers that we're taking a look at. So new listings here, again, same markets year over year versus 2019. So 2019 new listings, the amount of properties coming to the market is still down considerably versus 2019. Year over year, most of those areas are up, except for Portland, which is still down 7.7%. But when you take the average, up 3.3% year over year, but still down nearly 25% from 2019. That weekly change went from 645 to 652. So we added 7,000 new listings this past week, which again, I mentioned earlier was just over 1% and up 40% year over year. Weekly new contracts pending. So weekly new pending, 68,000 new contracts pending for single family homes. This sales level is staying basically unchanged for a couple of months when we should be in the peak home buying season. So why? Rates, affordability, all of those things are playing a part in why we're not getting more pending sales. We actually recorded 8% fewer new contracts than the same week in 2023. So we're actually down a little bit year over year on that one. Median price of new contracts, median price of single family homes on the market, just under 455, more or less unchanged from last week and unchanged from last year. Median price of homes newly in contract, just under 395, which is 5% higher than last year at the same time. And if we measure all the homes nationwide in contract, the median price, which we don't really care for median, but we're quoting it, 399,000, which is 4.4% above last year. And the last one, price reductions sitting at 38% of the market. Josh, I found this chart really interesting. It takes a bit to understand it. Came from Resi Club. You can see in the bottom right there. But the bottom number, or that pink area, if you will, let's go back. The left side is the shift since 2022 peak, right? So if it's in the pink area, it's actually down from that 2022 peak. If it's in the blue, it's up from that 2022 peak. And as you go to the right, that's the full appreciation gain since the start of the pandemic, if you will. So you can see, like Boise, for example, uses an example at the top. It's down 9.6% from the 2022 peak. However, it's up 47.7% since March of 2020. Crazy. But look at like Knoxville. Knoxville's up 70%, bro, from 2020.
If we only knew, we would have just all flown out there and bought like 10 houses pre-pandemic.
I mean, up 70. So they're up, what's that, 12, 13% since the peak in 2022, and up 70 something percent since March of 2020. So just over 4 years. Wild. But you got Hartford, Connecticut. You got a bunch of others in there. Just thought it was interesting data to take a look at. Just kind of shows you real estate's local, guys. We talk about it all the time. The world's not falling apart. Austin, Texas seems to be the one that has hit the hardest since the 2022 peak. It looks like it's down like 17, 18%, but it's still up over 40% from that 2022 peak. So, take it with a grain of salt. Depending on when you bought, you're still really good. Or maybe not, depending if you're at the end of that cycle. But nevertheless, I digress. Median income, Josh, what are we looking at?
This was a Visual Capitalist. They threw this together, and it's actually somewhat interesting because it's adjusted for the cost of living index. So they show higher incomes, but it's adjusted for the higher cost of living. And despite that, California, New York, Massachusetts, DC still come out really high, but it's about what you'd expect when you think of different areas of the country. Where would incomes be the highest? And Jeb, about a year ago, we did that show on moving to a lower cost of living area, and a lot of people pushed back and freaked out. Like, cool, I can go and I can get a house for much less, but I'm not going to make as much money. So one of the examples we love using, Omaha, Nebraska, right there in the smack dab in the middle of the Midwest, 72,000 median income versus California at 124. But for most of us in California, home price is $1 million, plus or minus $1 million. If you're in the populous areas, Bay Area, San Diego, Orange, LA counties. In Omaha, it's like $225,000. So it's 3x your income versus 8x your income. And when you look at, I had another chart, I should have thrown it in here, that shows by family size, how much of their shelter cost accounts for the household expenses every month. And it's like 33 to 38%, depending on household size. So just thought it was interesting in the context of you guys wanting to buy homes, interested in real estate, looking at things right now. So Jeb, we had 3 things this week come out that are market movers. We had Powell talk his semi-annual testimony to Congress. So that was yesterday and today. We're going to highlight a couple of the things that he said in his prepared remarks. And then we had a 10-year auction. And then tomorrow we're going to have CPI data. And again, a lot of movement, but not much happening.
Don't we have PPI on Friday too, or no?
I'd have to look at it. I don't think so, but
Okay. I'll look.
it's possible. Look at it while I'm jibber jabbering here.
Yeah.
So highlighted portions here of what Powell said. The economy has made considerable progress towards the Federal Reserve's 2% inflation goal, and labor market conditions have cooled while remaining strong. We've talked about how we believe, how one of the friends of the show, Logan Motoshami, thinks that the labor cooling is going to be the thing that will lead to Fed cuts. We just need to see a little bit more of it. They had mentioned that the next one's really important here. In light of the progress made both in lowering inflation and cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. So that's the Fed acknowledging that if they continue to be restrictive, there are risks of pushing the economy into recession, and they are cognizant and aware of that. Going on here, so the most recent inflation readings have shown modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably towards 2%. Tomorrow's CPI, although they prefer PCE, is some of that good data. And then he got pressured by the congressman that he was testifying before with their questions to talk, sort of tip his hand of where they're going. He says, I'm not going to be sending any signals about the timing of future market actions. So I didn't end up putting it in here, Jeb, but I think we're up to about a 72% aggregate probability of getting a cut by September. Doesn't mean the market's guaranteed that they are right, but it's what they're thinking right now. We had 3 treasury auctions this week. We talked about supply coming to market and how the market absorbs it, how the market wants to invest and buy these treasuries. So we had 3-year yesterday, 10-year today, a 30-year tomorrow. For mortgages, the 10-year is really the only important one. And the important thing there, the yield was 4.276. That's 1 basis point below where treasuries were trading in the open market. So that's good. It means a lot of demand pushed the yield down. Bid to cover was 2.58, just above the 1-year average of 2.52, meaning more bidders relative to less bidders if that number were lower. And then indirect bidders took 88.5%. You want to see that number higher. Just means that the market makers didn't have to take a bunch of that auction down. So when we look at that, this is really the highlight for this week, Jeb, is CPI. So if you look at the bottom numbers, headline and core, those are the numbers that we have falling off. So for core, we got 0.19 falling off, for headline 0.21 falling off. And the Cleveland Fed does this nowcast on what they expect the numbers to be. They expect core to be 0.28 month over month and headline to be 0.07. So when you see that, headline's going to drop tomorrow. That will make the news. That will be good. If the Fed and their nowcast is correct at 0.28, and when a point, that will round up to a 0.3, we have a 0.2 falling off, you'll see that core increased. So sort of a mixed bag. It won't be unknown to the markets. They reverse engineer this just like we're looking at here. So basically here, the expectations for core are a bit spread out, with some looking for 0.2, others looking for 0.3. We just showed you the Fed themselves are expecting 0.3. Depending on the results, we could see core inflation remain unchanged or increase to 3.5, which would be bad for the market. I think the market knows this is coming, and barring a big deviation one way or the other, we're not going to see much. So Jeb, here's the fancy chart we've been looking at. So I added a couple of things here. You'll notice that the green downtrend there, still intact, but I moved it out a little bit wider. That purple line is where we had it drawn, and we had kind of popped out of the top of that range 2 different times. And when you look at it, the new green line there shows it's just a wider range that we're in. And those blue aqua arrows there shows you this is what we're talking about. If you are in contract and you're going to be closing in less than 30 days and you decide to float, when you get towards the top of that range, that's when it is safer to float. It also feels the most risky because that's when rates are at their highest. They will generally make a run down to the bottom of that range, which you've seen. We've got 1, 2, 3 runs so far, and we're in the middle and likely the 4th run to the bottom of that range. So when you get near the bottom of that range, the odds are that that range is going to hold and we're going to make a run back up to the top. So if you're thinking in terms of locking, that's where you would want to see or consider locking. So what does that mean actually right now in terms of interest rates? 6.99 on the 30-year fix from Mortgage News Daily. I think they were reporting 7.02 last week. So actually they show 0.09 week over week. So they're at 7.08. So a little bit of improvement, not much. FHA and VA, again, right there just below 6.5%, about the same minor movement down. So we've got, for the most part, good data from all of these major data points we've been seeing over the last 2 weeks, and it just hasn't moved the market, largely because, Jeb, we see the Fed saying, we're not convinced yet. We're not convinced. They haven't really been hawkish, but they haven't said anything dovish that says these cuts are coming. So until that does, we're probably going to keep kind of trading sideways, slowly grinding lower in rates.
No, and that's kind of that lull that we're in at the moment. I did look. Producer prices are Friday, so we'll see what that does. It doesn't have it flagged as a quote unquote market mover, but it has in the past had an impact in some degree. So we'll see what it does. But with that, guys, we're here to answer questions. So if you have them, put them in the chat. We would love to answer them, help guide you guys in the right direction. And if you haven't done so already, do us a favor, like the channel, subscribe to the channel if you like the content, if you enjoy us being here. It helps. It does actually help. And if Josh or myself can be of assistance to you, that referral link right there or that link right there will get you in touch with us, and we can help you move in the right direction. So, Josh,
Jeff, we got an important announcement today. Our company, not this guy, our company got licensed in Virginia. It finally came through. So I will start working on my licensing. We have a lot of viewers of the show from Virginia. We've seen you guys asking questions, and we've had to say, hey, sorry, we can't help. So the team can help immediately. And I personally will be able to do that in the near future.
All right. Good stuff. Good stuff. Proud, I don't know. Can't read the whole thing there.
Proud liberal 24. They're going to think you're going.
Liberal.
They're going to think you're going blind.
Well, I kind of am. This thing's a super small screen, so I was like, I couldn't figure out how many letters were in between the. Yeah, it does. That makes sense now. Do you think it's it being an election year will result in lower rates by the end of the year? Election year or not, is it going to result in lower rates? I think the answer is yes. Lower rates by the end of the year, just because inflation's going to likely be trending lower. Unemployment's likely going to be trending higher. Job openings, that sort of thing, lower. Just, I think the economy is going to show additional signs, rather, of slowing. I'm going to start over.
Signs of sowing.
Yeah, exactly. Show signs of slowing, and therefore rates are going to likely trend down because of that, election or no election.
Jeb, the interesting part is we did an entire episode of the Educated Homebuyer podcast on this exact topic. Instead of just repeating what Jeb said, which I completely co-sign, he's dead on with kind of the way I see it, we don't even know who the Democratic candidate for president is going to be.
Oh, bro, so he's fighting.
So we have no idea how that would play out if this unknown Democrat were to win. And if that upsets you, I'm sorry. But if you're a Republican Trump supporter, I will upset you now. I got this from a longtime client, awesome, friendly person that left California to a red state, and they're thinking about buying another home. And they said, hey, you know what? We think we're going to put this off until after the election, because if Trump gets in, rates are going to go a lot lower. And I said, well, you may want to go back and look. Trump was elected one time before in 2016, and in 2017 and 2018, rates shot through the roof relative to where they had been before. And that is primarily directly because of Trump's policies. So I'm not making any judgment calls. I'm just making a qualitative measurement of what happened after those were implemented. So we have an unknown candidate on one side of the ballot, and we have a known who has caused increases to rates. Now, if you go back and watch that episode of the podcast, we don't think that the politics are going to play into it nearly as much as most people do. But a crazy tax and spend liberal filling that Democrat role and getting elected would be problematic. Trump coming in and wanting to do some Trump things would also be problematic, despite everything Jeb's saying previously being correct.
Well, there you have it. There you have Josh's opinion that he wasn't really going to give, and now he gave it. Let's see.
I said I wasn't going to go over the top of what you had already so eloquently stated, Jeb. I just co-signed your opinion.
Well, there you go. There you go. Let's see here. Omar says, went into escrow. A lot came up during the inspection. Roof, attic, insulation, electrical panel, possible damage slab. Wondering how much credits you would ask for. Omar, come on, buddy. We can't help you with that. We don't know the purchase price. We don't know any of this stuff. So something to understand when you're buying a home, if it's not new construction, there are going to be a laundry list of items, right? A home inspection report can be anywhere from 20, 30 pages to 100 pages sometimes of some of these things. I tell most clients, focus on the things that concern you, right? I mean, if they're big ticket items, then they're big ticket items. Some people, I have they're handy. They have a background in contractors, or their dad's one or somebody's one. So they're less worried about some of this stuff. They'd rather have, money or whatever. So you've got to focus on what's right for you. It's impossible for us to say. We don't really know. You say issues with these things. What are issues? Like, an electrical panel issue could be, hey, there's a bad breaker, or something's not wired properly, or could be the whole panel's bad. So focus on what the actual problem is. But from there, go get some bids on some of the stuff. Bid it out during your due diligence phase. Come up with a number you're comfortable with and ask for it. But talk to your agent. Your agent is the one that can really guide you through the process here. If they're an expert negotiator, let them do their thing. But what I don't think is smart, in my opinion, is when a home inspection comes back and the buyer wants everything done. Not reasonable. Most sellers are going to tell you to pound sand, right? Because most sellers have been living in the home with those problems for in many cases, an extended period of time. And they're like, they're not problems. They're problems to you. They're not problems to me. If you want them fixed, then you fix them, right? And I understand that mentality. So focus on the things that are, high ticket, things that are important to you. Because if you send my client a list of, say, 10 things on there, and, one of them's high ticket or two of them are high ticket and the rest are small things, guess what? We're going to pick the small things and say, hey, we'll do these, but we don't want to do the bigger ones. Right? So focus on the big stuff that matters, and don't create this long list so that you don't get, negotiation. But at the end of the day, you get to decide what you want to do, whether you want to move forward or not. So just, two friends talking here. Hopefully that's helpful. Josh, you see, here's a plug. This sounds like a ploy. This person,
we did not plant this person to ask
this person is a plant. Can you discuss some differences between borrowing from big banks versus small banks for mortgage loans? Guess what? We recorded an episode today, which is going to post next Tuesday, on the differences between different types of lenders: big box lenders, mortgage banks, mortgage brokers, credit unions, banks, just traditional banks, all of those. We go over all of them, pros and cons of each, why you shouldn't use certain people, and really go over it. So if you're interested in learning more, that's a 35-minute conversation, Josh. How long did we go?
Yeah.
35?
About 35,
where we really deep dive into it. So check out the Educated Homebuyer podcast next Tuesday. That episode will actually be posted, but we appreciate you asking. Josh, what do we have here? We've got a lot of comments in here. Do you think, so we get a report. So this is a question regarding Phoenix, Arizona market. I get a report from a buddy of mine who's a real estate agent there, a broker in that area. And he sends it to me about every 2 weeks. It's every 2 weeks. It's called what is it called, Josh? I just drew a blank. Cromford report. And basically it's a breakdown of everything, right? Pendings, actives, price per square foot, like all of these different things, just the direction of the market, what's happening. This is the worst time of the year for that market because it's so hot out. People aren't buying homes. Their best market is in like the fall, later in the fall market. So do I think prices will drop? It's hard to say. It's one of those markets that they did see huge increases in people moving there. They saw huge increases in demand when rates were low and all of those things. And a lot of that's moderated. So if somebody had to get out of that market and there's a lot of inventory, it's probably going to take a little bit longer to sell. I do think inventory is up there, but I don't remember what it said seasonally, what it looks like. But I think like any market, you got to see a lot. You got to see significantly more supply than demand in order to see a quote unquote drop in prices. I think more moderating than anything else.
A drop. So here's my take on it. Not just for Phoenix, Jeb, for any market that has moderated and leveled off a lot. For drops to come, a significant drop, it needs affordability to remain strained. So rates, conventional rates in this 7% or higher range. You show all the charts here every week, Jeb, and we're looking at it today. inventory isn't at highs for the last 2-3 years due to tons of people listing their homes. Listings are down. They're still remain constrained. It's that demand is down because of affordability. Many of you are here every week asking questions. You'd like to buy. Should I buy now? This price is crazy. Rate is crazy. Can't afford that. Once affordability improves, assuming that it does, that's an assumption, right? Doesn't have to, but assuming that rates come down and affordability improves, it's going to put a floor under every market. Let's say that it doesn't improve, then you could continue to see more weakness. And if the economy weakens more than what we're thinking, more than what most experts are thinking right now, you absolutely could see them come down. But until we know more about the future direction of the economy and what that means for interest rates, and generally what happens as the economy slows is when interest rates come down. So you're going to have weakness in the economy where there's less people that feel comfortable about a big ticket purchase like buying a home. But as the affordability improves, those people who are 33 and they married for a couple of years and the second kid just came, many of those people will step into the market. So I don't know, not specific to Phoenix, Jeb, but I just feel like we're kind of this push-pull where you and I have been calling for the last 2 years, this flattening and a long-term level market. But I think it's kind of where we're headed.
There you go. Good stuff. Christina is asking, do you know why you have to pay the FHA appraiser up front and then again on the closing costs? So you don't. When you pay it up front, it shows on the closing statement, but it just shows there as a cost that was incurred during the transaction. You're not repaying it. Now, in some cases, you could have to do something called a 442, which is like a final inspection. But even then, Josh, those are typically paid up front, are they not?
Most often they're paid up front, but they don't have to be. A lot of times just to get it done quickly, we'll go ahead and pay for it. So when I hear this question, I just say it wasn't explained to you well. Totally reasonable. I agree to get this question a lot. The borrowers will ask that. You say, the loan estimate and your closing disclosure, if you paid it, it has to be listed on there. It doesn't get to disappear because you paid it up front, because that's an accounting of everything that you paid, but it will show as paid outside of closing and won't show up in your total at the bottom that you're bringing in. So either you didn't ask anyone else the question, you said only Jeb and Josh can answer this, or you didn't get the right answer to that question, because Jeb's correct. It's paid outside of closing. It's marked as POC and you're not charged it twice. It just has to stay on that closing disclosure as a record of you having paid it.
All right. Good. Josh, you're going to have to help me with this one. Estefanos says, is it a good idea to use a selling agent to be for the buyer? So do you understand what she's asking here?
I just think they're just asking, does a buyer need to have an agent?
Yeah, I mean, if that's the question, I think it's smart to have an agent represent you separately from the selling agent in many cases, just because, when it's like the example that we like to use is if you go get a divorce, are you going to use the same attorney that your spouse is using to have negotiate the deal? Or are you going to try to find someone else to negotiate the deal? Not to say that person couldn't do the deal fine, but it's, two separate parties representing each other gives a better negotiation. And if you're a buyer trying to get the best deal, the lowest price, the best terms, you need an agent to do that. At least in my opinion. And so, yes, I think it's worth getting an agent to do that. Depending on where you're located in the country, we can help you. That referral link, actually scroll in the bottom of the screen right there, will take you to us and we can help you through that process. Josh, equity loans. Home equity loans are a big thing at the moment because rates are high. Most people have a really good interest rate on their first loan, don't want to give it up. So an equity loan is the easiest way to access that money in your home without messing with that first lien. And so what happens when you do it on an investment property? Is it different?
So it's not. It works exactly the same. The guidelines or the rules are going to be slightly different. They're not going to let you go to as high of a loan to value on a rental property as on your primary residence. Just like an investment property first mortgage has a higher interest rate, that home equity line of credit will also have a higher interest rate than if you were doing it on a primary residence. So that will impact your qualifications. But if we're asking, how do we qualify? This is a rental property you already own, so we'll have the tax return to show the cash flow on it, and then we have to add the repayment of this new mortgage and count it against that cash flow. And if it now results in you having negative cash flow, at least per the qualifying calculation, then we're going to have to hit that against you. Otherwise, you may still have positive rental income and can absorb that depending on the size of the loan. Now, in terms of finding it, most lenders do not do them. So if you look online, we often talk credit unions and banks. Credit unions are more aggressive in terms of the loan to value that they will go to. But credit unions and banks generally don't want to do non-owner properties, investment properties, but some will. But they will often have the best terms in terms of getting you the lowest rate, lowest fees, but be far and away more restrictive. So we have a number of options for these. But not a lot of options. There aren't a lot of lenders doing them just because there's more risk on a second mortgage, more risk on a line of credit, and we're layering that risk with it being an investment property.
All right. Susie asked, when you buy a home, is the homeowner obligated to pay the real estate agent, or does that fall on the company of the new home? Also, what's better, regular independent lender or one working from a bank? So, Josh and I often struggle weekly coming up with ideas for content for the podcast because we're 125 episodes. We've essentially talked about everything there is to talk about when it comes to real estate. So yesterday we're brainstorming and I'm like, hey, Josh, how about we do this episode? We talk about banks and brokers and different avenues and whatever, thinking that I just came up with that out of nowhere. And clearly you guys must ask it a lot, and it was just back there somehow. So we'll answer that question, part of it, Tuesday when we post the podcast episode. So check that out. But the first part of it, let's just answer it this way. Who pays the buyer's agent and or the listing agent when a home is sold? So typically traditionally what's happened is an agent like myself goes in and interviews a seller. The seller says, Jeb, I want you to sell my house. At that point, I negotiate a commission, a total commission. And of that commission, it is split between myself and a buyer's agent, right? So if you're a buyer and you have an agent representing you, the deal I negotiated with the seller covers their compensation. If you've been hiding under a rock, you probably don't know this, but there is a lawsuit that's out there at the moment. Department of Justice, National Association of Realtors have settled and have now changed the whole paradigm of the real estate industry and how commissions are advertised, if you will. So now your agent as a buyer could be paid by the seller still. In some cases, the seller may not agree to pay that commission, and it's going to be a conversation that you and a buyer's agent have to have prior to showing a home. So what's going to happen as of right now, August 17th is the day. August 17th, in order to see a home with an agent, you are going to have a buyer broker agreement signed. Even if you only want to see one property with them, if you want to see 10 properties with them, you're going to have a buyer broker agreement signed. Now, some states already have this in place. They've been doing it for years. Washington, I believe, is one state that's had it in place for an extended period of time. California, we haven't had this. Most of the U.S. hasn't had this. So understand, when you're out looking at property, you're going to have this in place, and it's going to clarify what that agent commission that you agree to pay that buyer's agent, whether it's coming from you or if it's coming from the seller or what have you. So it's a whole different conversation, which we've actually talked about on a podcast if you'd like to listen to it. But hopefully that kind of answers that question in a little bit more detail.
Jeb, let me throw a curveball and ask a question that you can't answer, but let's throw hypotheticals out there.
Yep.
We talked a couple of weeks ago on the show. I have this client in Tennessee that rolled into a Lennar new development and didn't register their agent. And after the fact was told, hey, we're not paying your agent. You came in and started talking to our salespeople without representation.
Which that's not abnormal. That's completely normal, by the way.
Completely normal. Yeah. So let's say that 2 weeks before that, the agent that was showing them houses, they wrote a contract, a buyer broker agreement that says, I'm going to pay you 2.5% if you find me a house. What happens in that situation?
It depends on how that agreement's laid out. Did that agent depend on what type of agreement you have? If that agent didn't find that house for them, they found it on their own through going out and doing their own thing, they may not be liable for it, depending on how that agreement's written. Now, in some cases, the agreement's written regardless of what house you buy. I'm compensated, whether I find it or you find it. And if that's the case, then they would, in theory, be liable for that commission, which I don't know. I think I would have a hard time telling somebody, hey, dude, you owe me money, even though you went out and found a house, like at a new construction thing. Like, I don't know. I operate a little bit differently, and I'm sure the opportunity will arise at some point in the future for that to be a negotiating or a conversation point. So we'll wait and see what happens.
Jeb, I want to just keep you talking. So we have a comment related to this, and we get this every time we do this episode. You can have a lawyer draw up paperwork to purchase a home. If instead of using a realtor, I consulted a lawyer, would that save me money? Are lawyers cheaper than realtors?
I mean, my buddy who's an attorney charges $800 an hour. So home inspections, typically hour and a half. You go out and see, I don't know, are they going to be there for the showings or not? So it depends, right? I mean, could it be cheaper? Could it be less expensive? Absolutely, it could be. Are you getting the representation that you need, that you expect, that you want out of the deal? Hard to say, right? I mean, attorneys aren't in the business of selling real estate, most of them.
They review contracts. So it's silly to say someone that reviews a contract, yes, they can write the contract for you. Sure. They're not going to find the house. They're not going to call the other agent. They're not going to line up the home inspection. Like we talked about, they're not going to review the appraisal with you. They're not going to go back and do those negotiations. And if they did, the hourly rates are astronomical. There is a website for attorneys called avvo.com. Go look. They list their hourly rates. You're not saving money. So it's funny that we constantly get that, and it's the only place in the world where someone would say,
here's what I'll tell you. If you have an attorney who is willing to work for a flat fee or something, they're probably not a very good attorney. I mean, that's the reality. If you have an attorney who's not is not busy enough and that they can now represent you to buy a home, I mean, you do the math. You decide if that's the person you want representing you, right? I want the attorney who's too damn busy to call me back because he's doing so much business, right?
I don't know. I don't know any attorneys that are dying to review
they're so good at their job that it's hard to get a hold of them. That's the attorney that I want. Let's see.
Jeb,
Proud Liberals asking another question. We're gonna just
so we didn't upset him with questioning.
What percentage of real estate agents? Well, I have no idea what you said. I was talking over you. What percentage of real estate agents will end up quitting the business in view of the court case decision with the buyer no longer assuming to pay the buyer's agent commission? So no idea. I mean, some people believe it's a lot. I think it's probably everything is overblown. The commission thing's overblown. The people quitting's overblown. The idea that no sellers are going to pay the commission, completely overblown. The idea that no buyers are going to be able to afford the commission, completely overblown. Like everything, there's a middle ground, and we've yet to see what it looks like because we're not even there. And at the moment, there's an appeals case on this thing. So the people that were part of the lawsuit realized that they're going to make about $5 after all the attorney fees are paid, which I don't know what they thought they were going to make when they actually did a class action lawsuit. But now they're appealing because they're like, why are we only getting, $20 when I had to pay $20,000 in seller commissions? Well, because you got, attorneys involved and they're the only ones making money. So I don't know if an appeal pushes this thing out further. We don't know. We don't know what's going to happen. And quite frankly, I don't really care. I mean, it is what it is. You just deal with it. You move on. Times change, and that's okay. That is completely okay. Josh, you were going to go somewhere, and I forgot. Susie gave us $5. So Susie, thank you for that.
Very nice. We had a fact check. We got fact checked. Mandy says that
never liked that. I never like being fact checked, Josh.
Looks like 30-year mortgage rates were between 4 to 5.25 from 2017 to 2019. Seems not inconsistent with typical pre-pandemic. I have no opinion on their relationship to anything political. Well, it's kind of a broad statement to anything pre-pandemic, because if you go from 2010, when we had QE1 through all of that through 2016, rates were consistently 4.5 and below, all the way down to about 3 3/4, which was assumed to be the lower bound. So when we have 6 years of that, and then they rapidly went from there to 4.5 to 5%, is it a huge difference? Is it a monstrous difference? No, but it's a difference because the deficits started growing again because we were collecting less taxes. So I'm probably risking being called a proud liberal myself here. I am not going to divulge my politics. It's just we get people from both sides telling us that their people are going to solve everything. And there's pretty much a case in point where we can show that none of those politicians are going to solve any of our problems.
Josh is about as far from a liberal as you can get. Just so we're clear.
But I get accused of it all the time online, Jim.
They don't know who you are. They don't truly know you. I know you. Let's see here. That's another one. This guy's just asking questions. I assume it's a guy. I don't know. Maybe it's a female. How much effect has HGTV had on buyer expectations when buying a home? I would say
big.
Hard to say, right? I think
big.
Yeah, but in what manner, right? Is it the timeline? Is it the type of property they're going to get? Is it what they get? I don't know. I think all of the above. I think where it's really had an effect is not so much on expectations as to what a buyer wants in a home. Like the design, the granite or the quartz rather, countertops, the grays, the whites, the shaker cabinets, the farmhouse, all of that. That's what's the impact, and that's the design out there. So that's more of the thing. But from a seller perspective, I think, which is a good way to look at it, sellers look and watch these shows and think, oh, well, I saw that home sold in 2 days and this happened quickly and all of these things just dominoed and it was all great and so got their house. No, nothing works as easy as it does on TV, and nothing is as bad as it is on TV. It's, again, somewhere in the middle. So hopefully that's it. Proud liberal. We are, I think we've answered all your questions. Yes.
We've got, good Lord. I just hate opening Pandora's box because we got all sorts of shit flying at us now. Robert says that title companies will draw up the contract. No, they will not. They will not draw up your contract. That's representing you in an agent capacity. They will not do that. So there is no title company in the world that writes up your contract. They will write up escrow instructions, and you can say there is no further agreement here between the parties other than these escrow instructions. That can happen, but they're not writing a real estate contract. They're not doing what a realtor does. So we have that. And then Robert follows up with, use a flat listing realtor when you sell and contact the listing agent when you buy.
Hey, you do that, Robert, and you tell me how it works out. We're moving on. Zofo. Can I negotiate the percentage rate fee in California with my realtor before selling? Yes, you can. I mean, that's definitely part of the process. You've always been able to negotiate your rate. Now, if you've got something in writing and you've got a binding contract now that's in escrow, probably going to be more difficult to renegotiate your fee unless there's dual agency involved, in which case maybe you can get the agent to renegotiate for some reason. But there's always negotiations happening, but typically once something is in contract, a little bit harder to actually make that happen. Josh, is there that much of a benefit to putting more money down on a purchase when it's less than 10%, say between 30 and 50,000 on a $600,000 home? So what are your thoughts on that?
So with current rates, you save about $6 per thousand. So when I tell people that, they're somewhat shocked. So we're talking let's take the difference between 30 and 50,000. That's $20,000. If you decide to put the extra $20,000, it comes out of your bank account. You no longer have it, can't have access to it unless you do a refinance and borrow it back out of that house. You save $120 a month. So what's the decision? Do I value a $120 lower payment, or do I value having access to that $20,000? And there's not a right answer. Everyone answers it differently. I have a listener to the show that we're going to be closing next Tuesday, and their appraisal came in low. So we were looking at it a couple of different ways. So he could make up the difference or he could leave it. So he made up the difference. It was an additional $18,000, and he was somewhat shocked to find $108 difference in the monthly payment. And he could have left the loan amount where it was without any change in the interest rate. That's not always the case. With his credit score going from 10% down to just less than 10% down, made no change in the interest rate. It did make about a $35 difference in the mortgage insurance. So your mileage may vary. You just have to look at the numbers and decide, what do you value more?
All right, here we go. So earlier we had someone asking about staging on a home. How much would you what percentage of the listing price should you spend on staging a home? It should never be a percentage of the listing price. It should just be a number that you're comfortable with. My stager charges the same to stage. Based on the size of the home, that's where things change a little bit. But I would say the range, most of the time is between $2,000 and $3,500 for the most part, on most of the homes that I sell. And they range anywhere from, 1,200 square feet upwards of 33,000, 3,500 square feet, somewhere in that ballpark. So somewhere in that ballpark, and stagers are different. Some charge you by the month. Some charge you, it's the single price for the entire duration of the listing. Some have it for 90 days. And then there's a renegotiation. There's all different types of things. And different stagers charge different amounts. So, hopefully your agent's got a team around them of somebody that the people that they trust and can go to, and people that they like to use. That's kind of how I operate. Now, there was a comment in here, Josh, that I saw. Somebody says that they would never use a stager. I want to read it because, Angel Eye says, I would never stage a house, have a nice kitchen, bathroom, and landscape. Basically use your money for the next house. Save your money for the next house. Put stuff in a storage unit, holiday items, make the house look bigger. Listen, terrible idea to do. I just had a house that was completely remodeled. It was perfect on the inside, and we could have not staged it, and there would have not been defects in the property and that sort of thing. But you know what staging did is it helped situate the rooms. It helped create the spaces, helped somebody see what that property was going to look like with furniture in it, because some of these rooms were a little odd shaped in the way that the layout was done. And guess what? We ended up selling the home for over asking price, multiple offers, doing the whole thing. Now, you could have said, well, it was going to do that anyway. Possibly, but I can tell you in photos, in marketing, and everything we did, that home looked a million times better with staging in it. And I can show you before and after photos of a lot of the properties that we stage, and there's a considerable difference in before and after. And I will tell you every single time that $2,000 to $3,000 that it cost you for staging in this case is worth every penny. So before you say you would never do it, maybe you never would, but that's the wrong way to look at it in my eyes. I think you got to look at, the possibility of having the rooms done right, and people not focusing on the negatives, the baseboards, all the things that aren't perfect in the home. And that's one thing staging allows you to do. All right, Josh.
Jeb,
Let's see.
Your tiny screen overlooked Mina's weekly $5 contribution.
I did. Okay.
And a question that she would like answered.
Okay, what would Mina like? What would she like to answer? Ask tonight.
I threw it up on the screen for you.
I can't read that, dude.
Is it worth paying for an inspector on a pre-drywall and final on a new construction? Contracts are written in favor of the builder, so does it really matter?
Absolutely. Yeah. Get a home inspection. I think it's important. If nothing else, it tells you all the defects that are currently wrong with the property that you can ask them, hey, listen, we're not closing until this stuff's done, right? Versus, putting blue tape and then they come back and do it after closing. When are they going to do it after closing? A week, 2 weeks, a month? Like $500 for, a home inspection, whatever your fee is. Get the stuff done when it's supposed to be done. Make sure there's not problems, just like anything else. Yes, these homes have inspectors from the city come out and look at them, but they're not checking every outlet. They're not going through the house like that. They're just making sure basic building codes are in effect. So yes, I think it's worth it. My opinion, the $5 that you pay here every week, if you just saved that,
you could pay for it.
You'd have that money back in no time.
Jeb,
although we do appreciate it, you'd have that money back.
Pay for the inspection for her.
Yeah, we could do that. But no, in all seriousness, even on new construction, I would consider doing it.
Jeff, Christina has a couple of quick questions that are actually good ones. I think these come up often. So following up Well, here, there's a follow-up. Why does the mortgage company tell you the rate is whatever? Then the fine print is over 100%. No one can charge you 100% interest. So what you're looking at on the loan estimate or the closing disclosure is the total interest percentage. You are literally the first person that I've ever heard from who's looked at this. Not quite, but very, very few people look at it. This one with the TRID disclosure requirements that came about in 2014 or whatever
Didn't we
it was.
just go over this in our last week's episode?
In the loan estimate episode.
Yeah.
I've realized that almost every question, Jeb, leads back to an episode of the podcast. But in that, the total interest percentage is the percentage when you factor in all of the interest. What is the percentage of your current loan or your original loan amount? And with current rates, it will be over 100%. That is not what you are paying in your interest rate. That is the total interest percentage over the life of the loan if you were to keep that house for 30 years and pay the mortgage off. So not the same thing. They are quoting you the interest rate that you pay. You don't pay 100% per year. You pay 100% over the life of the loan. And then following up on the thing, she says, well, thank you. I'll have to look into it. Talking about the appraisal issue, paying it twice, says I paid $70 over what it says on the closing statement. Go back and look at your, so if something was disclosed on the loan estimate, again, Jeb, leading back to the loan estimate episode, and that number was different on the closing disclosure, an appraisal is not something you can shop for. Since it's not something you can shop for, it is a zero tolerance item. It cannot change. So oftentimes lenders will disclose $700 or $800 for an appraisal, knowing it's only going to cost $550 or $650. Because if for something strange reason, something weird comes in there and it comes in high, they can't increase that amount after the loan estimate has been made. And then most importantly, when that closing disclosure goes out, we have to provide the invoice to show what the real number is. Just because I said $800 on the loan estimate doesn't mean we get to collect $800. I have to show the invoice for that appraisal, even if you, the borrower, paid it. So if the number on your final closing disclosure is higher than the amount that you paid and they collected it at closing, they need to refund that to you. But again, also look on that closing disclosure in your final settlement statement from escrow or title, depending on where you are, and see if it shows as paid outside of closing. They could have listed the wrong amount, but still marked it as paid outside of closing.
All right, two quick questions, Josh. Are lenders incentivized to find ways to call those 2% 30-year fixed loans due?
It seems logical. If there's a finite amount of money out there to lend and you have loans on the book at 2.75%, a book of mortgage bonds at 2.75%, and current rates are 6.75%, you would want those paid off and then to go ahead and relend that money at a higher rate. But the servicers that are actually collecting your payment, they just collect a portion of that loan as their payment for servicing it. So if that loan pays off, they may not be the servicer on the new loan. So they'd be cutting off their nose there. Then on top of that, there are laws that govern this. The only thing they could do is if someone started to default, they can follow the letter of the law and call that loan due as early as possible. But they can't be making things up to make you prepay that loan or pay it off early just because rates are higher right now. And we've gone through this before on the show. The government has been pretty clear that they expect on government insured loans, FHA, VA, USDA, and Fannie Freddie with quasi-government guarantees, they expect servicers to exhaust every possible resource to keep you in that home and in that loan. I've seen people with 2.75% rates get modified into a 4% loan. We have a viewer of the show that we did a purchase for here. They were, I think, 3.125 on that. Husband and wife, they were going to have their baby. They didn't want to raise their baby in an apartment. So we are buying a home. Within like 3 months of moving into the house, unfortunately, they got divorced. So they went down to one income, one of those family members making that payment, and she went and got a modification on that. So they can't really lower the interest rate. They stretched it out to 40 years. So now she has a 2.75 at 40 years. And using that situation, you would think they would go, hey, too bad, you can't make us the payments, sell the house and give us our money back. And they did not.
All right, good stuff. Josh, another question around rates. Bits of interest. Don't you get a better rate? Kind of a misconception here, but let's address it. Don't you get a better rate if you're either doing the minimum down or putting over 25% down? Isn't everything in between worse? Is the question mark. So there was this idea a couple years ago that the less money you put down, kind of the better rate you got. And it was kind of one of those, without the context, just the headline type thing. So where does it fall?
Not true. Those numbers all changed, and more qualified borrowers with bigger down payments are paying more than what they paid before, but there is absolutely still a benefit. So the client I was telling you about before, whether they put 5 or 10% down, the pricing was exactly the same. At 15, it was a little better. At 20, I believe it was the same. And at 25, it then got better still. So 25 will get you really good pricing, but that's not the best. It's not the absolute best pricing. That's at 40% down. And with lower credit scores, you may have to get all the way to 65 or 70% down before you get the absolute best pricing. It's a matrix, and it does improve. People with better credit scores pay less. People with a bigger down payment pay less, even though the difference, the benefit you get from having perfect credit is not what it was prior to those changes.
All right. Thylight, Jess. So excited and scared to begin trying to buy a home. We've been watching for a while. You guys are knowledgeable. We finally reached out to get things started. So congrats on getting started and moving in the right direction. So you can't buy a house if you don't start. So good on you for that. Josh, how long do I need to keep my mortgage to benefit my credit score? Is there a benefit to your credit score by having a mortgage? I guess is a better question.
It depends on if you make that payment on time. So I had this conversation with a borrower today. They said, "Oh, dude, you pulled my credit and my score dropped 6 points. If we do a refi, if rates drop in 6 months, is my score going to drop another 6 points?" They said, "Okay." In the context of this, a borrower with an 800 credit score, the 6 points is nothing. So now he has a 794. And what I can say, this is from personal experience, my score when I've had it pulled for a mortgage has done the same thing. So you have an inquiry, you lose 3, 5, 6 points. If you have a lower credit score, you might lose 10 points. If you do nothing in about 90 to 120 days, it will self-correct and they'll just go, "Oh, this person never got a mortgage." If you get the mortgage, it could possibly dip a little bit more because they go, "Oh my goodness, here's a new $500,000 debt." But after 2 or 3 months of paying that on time, it's going to help and improve your score. I had a borrower, those folks in Tennessee, they haven't closed yet, but we had to have him added as an authorized user on his mother's card. It bumped him from a 621 credit score to a 680 so we could get the best FHA terms for them. Now, once that mortgage hits, his score was not low from bad credit. It was from very limited credit. Once that mortgage hits and we get 6 or 12 months of rating, he's going to naturally have his own 700 score and can be taken off as an authorized user. So it will help you, but maybe 3 months at the soonest, 12 months at the longest, and it is absolutely predicated on you never, ever, ever missing a payment. Missing a mortgage payment is probably the worst thing you can do to alter your credit score short of a bankruptcy or foreclosure.
Yeah, you don't want to do that. It's not really good. Josh, there was a question here that I saw that was good a moment ago, and I'm trying to find it amongst all the idiocy here. Let's see. It was asking about, this gentleman says, do you think rates will go down before the Fed cuts the interest rate? So you mentioned earlier in the show, 70% probability that the Fed does an interest rate cut based on traders actually betting real money on the market out there, on the Fed funds futures, that they cut in September. So let's assume that September is the time which they cut rates. Is that built into the market? The Fed has been very transparent to some degree. Well, very, very transparent in how they approached Fed hikes, cutting closer to the chest. But that said, they don't like to surprise the markets. They're usually, you already have a pretty good idea before the announcement, the direction they're going to go. So if that's the case, is the Fed announcement going to lower rates at that time? Will it be built into the market? And also the Fed doesn't control interest rates, right? They just control the Fed funds rate. But by lowering the Fed funds rate, what does that actually do? Does it help the spread between the 10-year and the 30-year? And that allows rates to go down? Like, let's talk about this for a sec.
So historically, interest rates, both treasury yields and mortgage rates, improve ahead of Fed cuts because the markets, investors in mortgage-backed securities and treasuries, are watching the same data that the Fed is watching, and they get a pretty solid idea of what the Fed's going to do. Eventually, we're going to see like a 98% chance of a cut. So if that's the September meeting is at 72 right now, and we're on August 30th, and everything keeps going the way it is, it's going to be a 97, 98% chance of a cut. And a lot of that will be priced into the market already. Kind of an important concept. You said, Jeb, that the Fed does not determine interest rates, whether it's a credit card rate, any of those things. They don't directly impact them, but the things that they're watching does move it. Now, one of the big investment houses, I don't know if it was Merrill Lynch, one of the big ones, their economists came out and said, we think the economy is weaker and weakening faster than the Fed thinks. And 12 months from today, we believe we will have seen 8 Fed cuts for a total of 200 basis points. Then in that same release where they had said what they're expecting, they said, do not think that that means mortgage rates are going to be 200 basis points lower. We do not expect in the current cycle that we will see a 1-for-1 reduction in rates along with those Fed cuts. They said if we see 200 basis points, maybe you only get 70 or 100 or 110 basis points in mortgages. And it definitely makes sense from that perspective. So the last thing that you said, Jeb, is the spreads between treasuries and 30-year rates. Will that narrow? When that is going to narrow is when the market is convinced that we've seen a normalization of rates and there's not a potential for a big refi boom and losing all those recently originated mortgages. Because right now, ever since 2022, when rates started going up, any buyer of mortgage-backed securities does not want to pay a premium for that. They're like, I don't know how long I'm going to have that. I believe rates are higher than where they're going to settle out at. So whether they settle out at 5%, 4%, 5.5%, 6%, I don't want to own 7% mortgages because most of those people are going to refinance. So long answer, but there's a lot of moving parts there. And the other thing I was going to say, Jeb, and I don't know what your thoughts are about this. I think the markets, meaning treasury buyers, mortgage-backed security buyers, are a little gun shy because we've seen kind of 2 head fakes, especially the one last December where the Fed indicating that, hey, we're good. We're going to start cutting at the first part of the year. I think at this point, they kind of want to say, hey, prove it. So we think that you're going to do it, but prove it.
All right, good stuff. Couple quick questions here. Narcaster says, do either of you have much experience dealing with homes that require fire insurance in rural California? Excuse me, what options are available other than the FAIR plan? Honestly, I don't have a lot of experience with it, but FAIR plan is really your main option, especially in rural areas and high, wildfire, any sort of natural disaster type stuff in California. The FAIR plan is really the main option. Josh, do you have any? You deal with a lot more properties than I do because you're
there's no rhyme or reason to this, Jeb. I have that same client, we've used him as an example a couple times today, is buying in Santee, which is down in San Diego County, and it's out, but not so far out that it's only California FAIR plan. And he talked to a couple different insurance companies, like, we don't cover it. Here's your California FAIR plan quote. And got him with a State Farm guy, and he looks it up. He goes, yeah, we can cover that. And it didn't make a huge difference. It was $500 or $700 a year, so $50, $60 in the monthly payment. But for him, he did have options. But there are legitimately properties that don't have any other options. One of my tenants moved out. We helped her buy a condo out in Rancho Santa Margarita, and it is right up against the hills, high fire hazard area. No insurer. She called 10 or 12 different insurance companies. None of them wanted to touch it. California FAIR plan was the only option. So it's not always your only option, but if you're in a high fire hazard area, think about rural California, at least not even southern, central, anything below the Bay Area and inland. So the Central Valley, a lot of those areas are just high fire hazard areas in addition to being rural. So it can push you to just a California FAIR plan being your only option.
All right, we're going to do one more question here. Why do realtors not tell what the highest bid is on a house? When I ask what the highest bid is on the house, they won't tell me. Why is it like that? Any reason? So it's one of those things. So let's say, for example, you're one of the offers, right? So say you put in the first offer on a property. And let's say, for example, the house is $1 million and you put in an offer at $1,025,000, just for our conversation here. If the next buyer goes, hey, what's your highest bid? And I say, hey, $1,025,000. And then they come in with $1,026,000. Did I do you any favors? Absolutely not. Did I do the seller any favors? You might say, yeah, you did the seller a favor because that buyer's paying $1,000 more than the other guy. Well, what if I didn't tell you and you came in at $1,050,000 and we just left $24,000 on the table because you would have offered more before you knew what the last person offered, right? So it can be a service, it can be a disservice, and at the end of the day, it's somewhat unethical to do it. There's no laws against it. If a seller says you can do it, you can do it. But at the end of the day, you in many cases can be hurting yourself. So most agents will not tell you. I do tell agents after the close, like after we've accepted an offer, I tell agents on a multiple offer deal, this is where we ended up closing, so that hey, listen, your offer wasn't accepted, and this is why. This is the offer that we chose, and this is why my client chose it. Just so
just to be extra clear, though, Jeb, you said after closing you'll disclose it.
No, I'm sorry. After we accept an offer. After we
so
accept
you'll do that. Well, what happens if the inspection comes and that buyer backs out, and now
we'll go back to the fair. We'll go back to the market. I mean, and we'll accept those offers, and we'll accept new offers. But it's one of those things, like, some people, like, for example, we sold a house here in Huntington Beach about 2 months ago. It was listed at $1,350,000. There were multiple offers on the house. The offer we accepted was $1,450,000. There were offers at $1,400,000, and the $1,400,000 goes, well, why isn't my offer accepted? Like, we wrote a strong offer. It was cash. Actually, 4 of the 5 offers were cash on that property. Why isn't my offer accepted? Well, because somebody paid $100,000 more than you did. That's why. And it was cash, and it was all of these other things. So I want to be very clear. This is why, so that there's no, conversation about, my offer didn't get it submitted or what. No, your offer got submitted. It wasn't the best offer. So with that said, guys, it's been an hour and 4 minutes. That time of the show where we ask if you found any value, hit the thumbs up. If you're Robert, you can hit the thumbs down. That's okay too. We are okay with that. Just punch your screen as hard as you can. It's okay. But guys, if you found any value, do it. It helps the algorithm. If you haven't checked out the Educated Home Buyer podcast, go do it. Listen to us on Spotify, on Apple. In fact, you should put one phone on Spotify, one on Apple, one in each ear. Watch it on YouTube at the same time. It's kind of that, reading and listening at the same time. Just you take it all in. If you listen to it in 3 mediums, you just get it all. And that's the best way to take in the content, Josh. So
absolutely.
All right. Referral links fill in the bottom if we can help. Until next Wednesday, we'll be back 5 p.m. Pacific Standard Time. Adios.
Amigos.